Hi, welcome to Market in a Minute. The market is killing the momentum stocks. We think this is ultimately going to be really positive. Now, Google reported last week and they've had negative cash flow. We think that this is going to continue for a while. And we have a big update of Anavex Life Sciences. So if you're a shareholder in Anavex, many of our investors have this stock. It's very frustrating. We decided we don't want to be activists, right? But we think we need to. We hate losing money. Okay, this company has a really good pipeline, and I think this company is getting destroyed by the board, and the board needs changed very quickly. Disclosures, please read those at your convenience. Market update. So a couple of things that are bothering the market. We covered it last week. They're pretty obvious. One is oil prices, and the other is the concentration of technology in the overall indexes. So the concentration is at such a high level that again it's at a bubble level in terms of the investors owning so much in technology. Now, oil prices, one of the top concerns for the market. It impacts inflation, which impacts interest rates. So oil on Monday pulled back quite a bit. It got above $90 a barrel. Now it's in the low 80s. We think it maybe potentially could go in the low 70s if Trump can construct a nice agreement again. Keeping our fingers crossed on that. Obviously, that's not an easy task to do. If you take out the war, we think the natural area for oil is somewhere between $50 and $60 a barrel. So that would greatly help the inflation outlook over time. So as time goes by, we think oil just naturally goes down into that $50 to $60 level. And because there's probably more oil being pumped than normal at this point, it maybe drops below that $50 level. If oil does pull back as we expect, we think we've probably seen the highs in the 10-year Treasury, provided that Japan doesn't repatriate, over $1 trillion back to their own country by selling treasuries. We think we're probably at a high in terms of oil price. We're probably at a high in terms of the 10-year Treasury. So it went to over 4.7. Now it's down to 4.63. So we view. We got a question asked today, which was, why are interest rates changing so much? Why is the 10-year Treasury going up so much in yield? It's all based around what the expectation is over a long period of time around nominal GDP. So that's the sustainable real GDP growth rate plus the long-term inflation trends. So if the market has a lower view of inflation or a lower view of sustainable real GDP, that 10-year Treasury could drop, significantly from where it is. We think the fair value of the 10-year Treasury in terms of its yield is somewhere between 4 and 5%, unless it's being manipulated by the Fed, right? So that does happen, but we don't see that happening in the near term, or the economy enters into a recession. So the bottom line with this is if oil drops into the low 70s, we get a real deal out of Iran, we think we could see a very nice significant move in the overall stock market. Probably equates with technology being a little bit under pressure. Maybe it bounces, but all the other sectors might go up quite a bit that are more interest rate sensitive or that are very undervalued because they've been left behind because of what's happening in technology over the years. Now, we like Google, all right? We think Google is one of the premier, if not the best company that we've ever seen, really. So Google's earnings report last week showed this table shows it. I know the printing's kind of small, but they had in terms of free cash flow negative almost $6 billion in free cash flow. That hasn't happened. So this is something new for Google. Google's always, produced free cash flow. They have on their balance sheet 126 billion in cash. What they said was they guided to 205 billion roughly in capital spending for this year. Well, that increases the spending instead of roughly 45 billion a quarter up to 62.5 billion per quarter over the next 2 quarters. So obviously cash flow is going to turn probably even more negative than what it was just reported. Then they announced that 2027 would be, in terms of capital spending, up significantly. So what the hell does that mean, right? So if they're going to do 205 billion in spending this year, up significantly to me means 300 billion. So it could equate to Google going through a lot of cash and maybe driving this 126 billion in cash they have to very low levels, if not using all of it. So kind of where are we in this capital spending cycle for AI? I think we're in the latter innings because even a great company like Google, massive cash flows, can't keep spending all their money that's coming in and all their money on the balance sheet as well. The technicals of the market. So the technicals are flashing a big caution sign. So we had the S&P break through that 20 and 50-day moving average, even more so last week. It's getting down close to a support level, so that's the good news. But what we want to see for a sustainable trend is a nice move back above that 50-day moving average. As you can see, we've been moving sideways now since May. So this is not a bad thing that's happening necessarily. But we have 2 tough quarters seasonally, August and September, in front of us. What's causing this? It's coming out of the momentum stocks. So the momentum stocks are a big part of the S&P 500. Heck, you could say they're half of the S&P 500 at this point, given how large technology is of the overall total. So momentum is down 12.6%. The S&P 500 has fallen only about 2.5%, but it feels a lot worse given these momentum stocks really falling in a big way. And again, this broke the 50-day here recently, which is, for us, it's an early warning. It's a signal for us to start to get defensive. So 2 weeks ago, we started to add some hedge. Last week, we added a little bit more hedge. So we're being defensive. We think to ultimately move the market higher, nicely higher, we need some of this momentum money to move out of these high-flying stocks into the overall market, to the rest of the market. That way, those stocks could actually move up quite significantly because they've been depressed. They're a smaller part of the overall markets. So a little bit of money moving in their direction could cause these stocks to move greatly. So the underlying market itself seems to be holding up well. Okay, if you look at the RSP, the equal weight S&P 500, it's not making new lows or not making recent lows. It's actually up. It's up from the previous high. So it's holding in there great. We're actually very impressed with how the rest of the market is performing. Thank you. Take care.